You probably noticed some unrest in the cryptocurrency industry, even if you don't live and breathe it. The chaos is evident in the attention-grabbing headlines about missing apes and collapsing stablecoins. But what is actually happening? Before we move any further, we hope you will give this video a big thumbs up. Tap the subscribe button so you will never miss out any of our updates. Let's start. Slowly at first, then all at once, like so many other things. Consider Bitcoin, the first cryptocurrency, which accounts for about a third of the market's value. Since the end of the March, the price of a single Bitcoin has been steadily declining along with a general downturn in the technology industry. Today's topic of discussion is, crypto has crashed. Can it bounce back? That makes sense because, like buying any other tech stock, investing in Bitcoin is essentially a wager on the prospect of further technological change. The entire sector started declining as a result of the rising inflation, stifling post-pandemic growth on both sides of the Atlantic, and a nebulous perception that irrational exuberance had resulted in an overvaluation of tech in general over the previous few years. The dam eventually broke in early May. It decreased faster in a week than it had in a month before. Contagion from the disastrous failure of another cryptocurrency project called Terra, which had once been valued at more than $50 billion, but ended the week practically worthless, was the immediate cause. Probably with high inflation undermining the appeal of the high growth, low profit investments, and a string of pushing a revolution from the largest companies raising fundamental concerns about the limits to their potential expansion, tech stocks as a whole have been crushed in recent months. Fans of the Bitcoin may promote the idea that their currency is a kind of digital gold, with a finite supply that makes it an effective inflation hedge. However, in reality, the chance for a digital revolution decreases as growth prospects worsen, inflation increases, and Bitcoin prices plummet. In addition, it appears that retail investors dominate the cryptocurrency market, treating it as a cross between traditional day trading, already a spectacularly risky way to invest money, and pure gambling. These investors might be forced to sell part of their holdings when growing expenses bite, further damaging the sector. A stablecoin or cryptocurrency token with a set value of typically $1 was the goal of the Terra project. It's nothing new to use stablecoins. The two most well-known in the market are Tether and USDC, and they act as banks in that they accept deposits of the currency in exchange for stablecoins that can later be redeemed for cash. The problem with this reserve-backed concept is that you have to trust the stablecoin's creator to keep the money secure and accessible rather than betting it all on red in the Las Vegas to turn a quick profit with other people's money. There has been a long-standing drive for a new kind of stablecoin that will maintain its value algorithmically rather than through the actions of the bankers, because just trust us is anathema to the cryptocurrency industry. One of those attempts was Terra, a pair of the currencies with one called Luna, intended to float freely, and the other called Terra, intended to always have a value of $1. If the price of Terra rises too much, Luna owners are encouraged to print more because they can always convert it for $1. Additionally, Terra may always be converted into Luna for $1. Therefore, holders of the currency are encouraged to destroy it in order to drive up its price if it falls too low. The system only functions if Luna has any value at all, which is the problem. Thanks to an aggressive offer to pay 20% interest on saving held in the currency, it did for a while. When investors began to withdraw their funds in the midst of the fall to cover losses elsewhere, it abruptly stopped happening. With investors converting Terra into Luna, the price of Luna dropped, which led to the next redemption lowering the price of Luna even more, and so on, creating what's known as death spiral. The Luna coin's value dropped from $80 to roughly 1,000 of a cent in a matter of weeks. The test was completed. The winners and losers are who? The answer is straightforward on the surface. Those who sold their cryptocurrency holdings in early April are the winners, and those who bought them are the losers. It happens frequently enough in this industry that there is even a catchphrase for those who are still standing when the music stops. Hold. Hold on for the dear life. This is an implicit guarantee that boom times will return, that only those who resist the urge to sell at the bottom will profit in the following stage of the cycle. However, there are differences. Those who purchased shitcoins, which are low-effort projects where almost everyone involved acknowledges that the goal is simply to buy low, sell high, and leave someone else picking up the pieces, have lost much more money than those who held blue-chip cryptocurrencies like Bitcoin and Ethereum, which have only lost about half of their value from the peak. Similar to individuals who were able to convert their cryptocurrency into cash, those who were able to withdraw their funds into a stablecoin that withstood the volatility are in a nearly same position. Similar trends can be seen in other economic sectors. For example, if you purchased a Bored Ape NFT at the height of the market, it may be difficult to resell it for exactly what you paid for it, but it's still simple to do so for more than £10,000. Not if you purchased, for example, a screenshot of the Jack Dorsey's very first tweet on Twitter, which you paid $2.9 million for, but is now only selling for $14,000. The corporate bakers of the industry, including venture capital funds like the Andreessen, Horowitz, and the successful businesses that have produced numerous boom-bust cycles, appear to be the biggest winners in all of this. Giving yourself the power to print something for free that everyone else is eager to purchase is ultimately the only thing better than purchasing low and selling high. The blockchain concept, a decentralized ledger that tracks ownership of the digital assets without giving any one person or organization control over the network, is the key innovation that underpins everything in the cryptocurrency sector. Other common features include the use of the cryptographic wallets, which allow assets to be held in a way that prevents any transactions without the secret key of the account holder, and proof of work, a method of securing a blockchain by requiring enormous amounts of energy to be burned every second in order to be economically dissuade attackers from trying to break the system. In different ways, each of those technologies has faced criticism. For instance, proof of work is to blame for the astounding carbon footprint of the Bitcoin network. It's equal to that of the entire country of Thailand. Meanwhile, the blockchain itself serves as little more than a painfully slow and ineffective database in any situation where decentralization isn't the primary benefit. But in other situations, the technologies continue to be extraordinarily potent, where there is no centralized body to enforce the rules. Any situation where a government might try to halt economic gravity, for example, becomes much more difficult to enforce. There may be campaigners seeking funding to advance democracy in nations with strict capital controls, as well as ransomware dealers extorting money from hospitals and schools in countries lacking extradition treaties. When traditional financial institutions have ventured into the cryptocurrency space, they have done so with caution and have considered it as an investment opportunity with a correspondingly high level of risk. Even if the entire industry vanished overnight, there would be few opportunities for contagion. Investors in venture capital funds like the Andreessen Horowitz recent $4.5 billion round of the investment in the cryptocurrency companies would lose everything. But systematic effects would be highly unlikely. The knock-on effect would have a significant negative impact on some conventional stocks. But even if it doesn't result in a moment of bank failure, a la Lehman Brothers, the crypto economy is still worth more than $1 trillion. And losing that much money doesn't happen without having a significant negative impact on the real world. It might start or intensify a recession, or it might cause another wave of more common issues like bankruptcies, foreclosure on homes, and insolvencies. Can cryptocurrencies make a comeback? The cryptocurrency industry has previously endured disastrous crashes. Yes, it's bad, but winter precedes spring, which is what sparked the most recent discussion about us entering a crypto winter. Investors are urged to wait for the market to thaw and simply sit this one out. The possibility that things could change this time is cause for pessimism. In general, the growth of the cryptocurrency industry has come from attracting ever larger numbers of new users. However, this most recent bust might be so significant and widespread that it will be difficult to find any new clients. And eventually people who keep their savings in cryptocurrencies will have to sell in order to pay their real-world bills, but they won't know who to sell to. The pool of naive money to buy in the next time around will be very small. If every developed country lost money in the crypto crash, I know someone who did. However, effort on creating consumer goods continues in the interim. Perhaps someone will have created a pay-to-earn game that's truly entertaining or an NFT that millions of people would like to acquire. In either case, the time is running out. This is the end of the video. If you liked it, tell your friends and family about it. That would be a big help.